Hey, everybody. Welcome to Market Mavericks. I'm joined by Mike McGlone here. Scott Melker is off today, but we are here to delve into all the macro, all the data, the charts, what the heck is going on, because let's be fair, some of the economic data over the last few days has been honestly a little shocking. Well, maybe not to us. We've been kind of warning you guys, right, Mike? I think we've given people a good heads up that this is coming, but the markets seem to be a little bit shocked. We saw a big sell-off on Tuesday. The market's holding steady today, but we do have the jobs report tomorrow. So, Mike, why don't you lay the groundwork? Talk to me about the beige book that came out a couple days ago and the JOLTS number.
Yeah, the beige book was across the board weaker than expected. JOLTS was weaker. The data today was a little bit better, but ADP was lower than expected. So overall, the numbers somewhat mixed. Some of the isms and were a little bit better. But the bottom line is number one thing tomorrow is that unemployment rate.
Yeah.
And you got your screen up so good. So U.S. job openings, non-farm payrolls. Yeah. So
just to go over this number, it was supposed to be around 8.03 million job openings, and that's what JOLT stands for, folks. Job openings. So it's how many businesses have openings to be able to hire people. So the idea is the higher the number, the better. It means that the businesses are hiring a lot. So the fact that this number came in at 7.673 million, basically 350,000 less than expected, that tells me something. It tells us that businesses are starting to pull back on wanting to hire. Now, listen, historically, and Mike, you probably agree with this, historically, this is still a pretty good job openings number, but to me, it's the velocity of the decline that is somewhat alarming, right?
Yeah, well, it's a key lesson in markets I've really enjoyed lately. I'll talk about this chart in a second, and that is, it's really made me a lot of money in my career, particularly in 2000 and 2002. I was I was a bit early on that one, and then of course in 2008. And then that is markets, it's the human nature of when markets go up way too much and then go down. People sometimes forget that. So for instance, there was a headline I saw the other, NVIDIA was down like what was it, 9% in one day. And, it was all over the tape, read everything. You failed to mention it's still up 119% on the year. I mean, it's just what happens. But it's the way human nature works and psychology works. And what I want to tilt over to is what I think is going to be happening now is, and that's the crocodile jaw pattern. Now, I overlay this with gold, but if you just look at the 30-year bond yield, it's rolling over from the highest level in about 2 decades. I mean, just to be able to say that, it's like, okay, and if that's really going to happen, these are big opportunities for tactical traders, and it's probably a significant time for the people who have been long and making a lot of money in risk assets to lighten up and focus on risk off assets. But at the same time that's happening is volatility. This is the VIX volatility. These are 200-day moving averages. The VIX volatility index minus the T-bill rate is bottoming from the same level that this was the indication that made me a lot of money in 2008. The problem was I was early. It started rolling over in 2007. And I think that's all that's happening right now. So one thing that I need to mention is that on the quarter now, Bitcoin's down about 9% and TLT is up about 9%. The key question is, does that continue? And all my indications are, yeah, it's just getting started. So it's not good for the average person who's buy and hold and will never sell, but for the tactically oriented, which you are, and that's why I want to kind of dig in some of your next trades, it's just getting started in my view, and I can dig in some other ones later, but back to you first.
No, and one of the things I'd like to just stay on the macro for a second is that, so we've had JOLTS data weaker, beige book weaker. This morning, the ADP was weaker, which is private sector job hiring. So a lot of people are now expecting and saying, what is tomorrow's jobs number going to be? But one of the things that I thought was interesting that I want to explain to people is, we had the ADP number at 8:15 this morning. It came out, I think, at 99,000. And then the unemployment claims came in really actually pretty good at 227,000. But what this tells us something really, really important. It tells us that the cycle is working properly. So when an economy slows, you don't go from hiring a massive amount of people to just laying everyone off. What happens is you go from hiring a massive amount of people to not hiring as many people, to not hiring anyone, to then laying people off. So it makes sense why the unemployment number, or the jobless claims, I should say, were still low, because businesses are not at that point in the cycle yet where they're mass laying off. Now, we've still heard a lot of big tech companies cutting jobs, some bank stocks, but it's not in mass yet. But I do think that's coming. It's just further down in the cycle. And then the last thing I want to get your read on here is this chart. And I know you know what this is, but look at this. The inversion of the yield curve, the longest ever, I believe, Mike, has now uninverted. And if we look at the recessions previously, it's always uninverted first, and then the recession occurs. So walk us through what you think's going on here.
Yeah, it's one of those things. Can it be that simple? But it's not. It's just been the longest period since 1979, 1981. I remember that one well because my father was a CFO of a steel company. He described it as a pretty severe recession. But the thing that's happening is the delayed reaction. This chart has been this way for 2 years. And starting about a year ago, most people gave up on it. It's classic human nature. But now we're all starting to realize, uh-oh, this might be worse than we all expected. And the Fed is going to start easing, but it might be just what Greenspan did in 1994, 25 basis points at each meeting until they have to. But to me, that's also indicative of when you have bond yields that are much lower than the front end, that's an indication the market's expecting deflationary forces in a recession. Now, I like to tilt it over to that's just the US. If you look at the same thing compared to China, I show this same chart in China. This is just the US 10-year note, the Chinese 10-year note minus the US 10-year note. It's also inverted, but the same amount as it was in 2006 and 7, right before the big financial crisis. It's just where I think our things are going. The most significant demand growing economy in the last 20 years is tilting over to a severe recession by looking at its bond yields. So I overlay this with spot gold divided by the S&P 500. And here's something now you'll enjoy, the chart pattern of this is the most significant cross in terms of gold that I think is in a macroeconomic outlook. And it looks like it's putting out a bottom out head and shoulders. If you take gold divided S&P 500, it's historically very cheap. But this low here was right, at the end of 2021. It's a bottomed out head, left shoulder, 2008, right shoulder right now. If this starts ticking up, which I think it will, with the inversion of the curve, disinversion of the curve, with U.S. yields kind of heading towards China, that's a significant macroeconomic development where gold's beating the stock market. But it's not so much beating; it's just catching up. It's really cheap versus S&P 500, or is the S&P 500 really expensive?
Yeah, such an interesting thing right there. And I think just touching on this weaker macro data, and this is something that you've brought up quite a bit in the last month, 2 months, 3 months, is that you've been saying, hey, listen, oil's going lower. And people are like, oh, but the economy's great. Why is oil going to go lower? Or why is gasoline going to go lower? Well, basically, those have been leading indicators now for this weaker data because we have seen, look at gasoline here. So gasoline has broken a major wedge pattern. In fact, I could actually stretch this trend line back even further. There was a breakdown here, and we've seen this come down significantly on gasoline recently. And then we know oil, right? U.S. oil price has really tumbled. I mean, look at this breakdown on oil now trading below $70 a barrel. And these are all indicators. I call them breadcrumbs, right? So while everyone else is like, oh, but Jerome Powell says it's going to be a perfect landing. Oh, the talking heads on the TV, they're talking, no problems, right? But then you see oil breaking down, and it's like, wait, why is oil breaking down then if the economy is going to be chugging along and using so much oil? And then here we are, right? So, yeah.
Yeah, let me tilt over back up. I'm piggybacking that one, showing my screen. This is a headline from my colleague. You put this out today. Liam Denny, American drivers signal a top in gasoline demand. Liam Denny. Now, some of us will know I started pointing this out almost a year ago. Gasoline demand, diesel demand, paperboard, containerboard in this country are in downward recessionary trajectories last akin to 2008 and 2009. And the same thing I got in oil with you is I put out I still think Ben Early stopped out. If I was a trader, I still think oil's going to $40 a barrel. It's not profound because it's what it always does, at least since 2008, and actually since the peak in 1990 when Iraq invaded Kuwait. I mean, I was in the trading pits then. I remember getting stopped out first and then making a lot of money on the way back down. But here's the key thing I want to point out is the last time we broke down from a similar long-term trend line, like you see here, that was distorted by the pandemic. Same thing then when it broke down in 2014, it was distorted by the great financial crisis. Is the 10, the 30-year bond yield's hovering at 4%. So to me, that's the next big trade is a 30-year bond yield dropping below 4%. And that's why I've been way all over. I mentioned TLT. I can't give investment advice, but bond yields just heading towards where they are in China. So based on this chart, what stops bond yields from going to 2%. Nothing in a big way. It's just going to take a while to catch up to the Fed. But to me, this is the breakdown that matters. But it's also the key thing that you've heard from people like Jeff Gundlach. And really, if you look at commodities, we are in a severe global recessionary trajectory in terms of commodities. Gold is making record highs. It's up 30% since almost 35% since commodities peak in 2022. And the Bloomberg Commodity Index is down about 30%. That's severe deflationary recession. I showed you Chinese bond yields. To me, that's all that's happening. Is this great market reset is just getting started. It's a question of where does it stop? And I'll tilt back to you, and then I have some other macro ones I want to show you.
Yeah, so just piggybacking on your oil talk about $40 a barrel, I said, wow, I was looking at the charts this weekend on a longer term basis, and I was doing research, and I said, well, if oil breaks this little wedge pattern here, I'm by the way, I'm on the monthly chart now, which it's starting to break. How low could this go? And lo and behold, I was looking at the chart, and I'm purely pretty much a trend line guy. I look at the different trend lines, and I like, oh wow, what if we connect these lows? Right. So obviously I'm ignoring this one caveat where oil went negative because that was the COVID freak out with that whole situation. Yeah. But this line going back to 1998 connected to the lows of 2016 to the lows of 2020 right here in December. And what price? $39 and change. And then I also say, oh, wow, well, what about connecting the high here from 2000 through the high of 2003 through the low of 2009? And lo and behold, right in that same range. So I always look for confluences to kind of reconfirm a potential downside target. And this matches perfectly with your $40 call. So that is pretty cool, man. I love that.
It's the macro too. So you look at a chart like this, and it makes sense technically. I remember guys in the trading pits would only look at a chart and actually deliberately enjoyed the fund and ignore the fundamentals. But the fundamentals very much back that up. I showed you that story about declining demand. It's China. Just look at their bond yields. Right now, the 10-year note yield in China is 2.15% or so. And the U.S. is just heading that way, 3.73. So to me, it's all heading that way. And it's just a natural reaction of what happens to crude oil goes down because it went up. But I want to tilt over some, to me, the big macro that I got a lot of traction on this one today. I put this out. And this is going backwards. We got about 100 years here. So can't expect it to happen overnight. It's just when you it's the Buffett model in orange. It's just it's the S&P 500. I'm using that as a proxy for the market cap of the S&P 500 of the stock markets. It's about 2 times GDP. So it's right about a little bit less. Divided by GDP, and these take trillions times 100, and you have a good proxy for the stock market divided by GDP. It's just peaking from the highest level since the 20s and 30s. Okay, so maybe it doesn't matter anymore. But at the same time, I take same thing S&P 500 versus gold. It looks like just a little risk of that all going back to 1-to-1 is what I'm concerned about. And is that getting started? And that's why I point out one other little thing like this. You look at a little bit of shorter term. The lesson I like to say is, right now the S&P 500 is 20% above its 100-week moving average. That's very rare to happen. Now, there's periods it has happened during that big run up in the 90s, and then it collapsed during the biggest money pump in history, right in 2022, and then it collapsed. And we had, but here we are, 20% above the 100-week moving average. Just not a place you're supposed to buy. I overweigh this with the S&P 500 with gold divided by treasury. So I'm thinking what's happening is there might be a gold blasting off, might be passing a little bit of a performance baton to U.S. Treasury long bonds. Obviously I've been saying it for a while. I've been wrong, but maybe it's catching up. But to me, this is the thing that's going to be happening tomorrow. We're going to be hitting the tape with this number. And I'm afraid that the consensus is, I'll show you here, the consensus is that the number is going to be right here, 4.2% unemployment and non-farm payrolls around 165. Now that doesn't really matter, non-farms, because they're all revised. It's some of the data, but if we get 4.3%, that's confirmation that everything's tilting lower. I think it's probably going to be 4.2, but then it's what the market does. And to me, it's the bottom line for everything is, everything I show is completely dependent on the U.S. stock market staying elevated. China, the rest of the world, bond yields, even crude oil starting to tick down. If the U.S. stock market just goes back to this 100-week moving average, which is, it's got to drop 17%. It's normal. That was where it was back in December. that is a severe deflationary dominoes, yet it's just normal reversion. So to me, I'll end with this. That's what I'm worried about is after we get that to number tomorrow, if it confirms a weaker economy, okay, they'll probably hit stocks. And then they'll price for more Fed ease, and the Fed's not going to ease more than 25 at the meeting, unless, they maybe will ease more. It's what if we get a normal number, a tick number, and stocks go down anyhow. That's the scenario at some point I'm looking for, and that's what really has made me a lot of money in the past. When you just see a market that's too expensive and goes down because the number one reason, it went up too much.
You brought up like going to history and in terms of going back quite a ways. And I always find that really helpful because number one, we always think we're different, right? How many times did people say, hey, this AI boom is different than the dot-com boom, but now SMCI is down 75% off of its highs at $400 when it was $1,200, right? NVIDIA, granted, it's not down as much, but it's already coming in. But we saw Tesla do this in 01. We saw Cisco do it in 1999, 2000. And one of the charts that I've really been, I found this weekend, and this is using a logarithmic chart. So I had to switch it up because going back that far, you have to look at it in percentages versus in terms of real dollars. But look at this chart. This is a trend line going back to 1899. So 1899 to the just prior to the stock market collapse and Great Depression connects perfectly through the highs of the dot-com bubble on the Dow Jones Industrial Average right to the highs in 2021. And look at where we are right now. Now, when I look at this chart, I say, okay, we see about the FOMOing in of retail investors and them always buying the dip. Does this chart make you feel comfortable about buying the dip when it's a 5% dip in the markets or a 3%? To me, I don't see it. This chart freaks me out. I mean, we're literally talking about a trend line that puts in the high from just before the Great Depression. And by no means am I calling for a Great Depression, but in the very least, where is the reward? Is the reward to the downside or is the reward to the upside? And until this line is really taken out significantly, you have to err on the side of caution. But it's really an incredible trend line to think it goes back 125 years. Incredible stuff.
You got me on that one. Darn, I thought I had a lot. I was pushing 100. But so here's how that works from an ex-trader like me, and that's why I respect with Judy. If I were to put a short on there, it blasts through my short and then go down, stop me out and then go down. That's why I just look over at treasuries. It's just
that's
the way
markets
it's worked.
Do. Markets. I always say markets are like real entities, man. They want to push the most amount of traders out of the trade before they go in the direction that everyone thought it was going to go in, right?
Maximum pain. So one thing I really want to rope into the history is into what's been happening and into the future is this is definitely this chart is roping over to Bitcoin a little bit. I think what's happening, and oftentimes I miss things a lot, and sometimes when I get it on, I'm early. And this kind, I think, is what's happening is Bitcoin is becoming the last best trade. It was the next best big trade for quite a while. It's shifting rapidly because everything I've talked about Bitcoin for last year, a lot of stuff has happened. I mean, we had ETFs. My firm is dug in. Both political parties are getting it, and all that stuff that we wrote about and people pushed back on years ago. But to me, this is the key thing I'm worried about. You just take Bitcoin minus its 100-week moving average. It's doing what it's supposed to with a maturing asset. It makes lower highs and head lower, but it's put a pretty significant turnover. Again, I take the S&P 500, divide by its 100-week moving average. These things are rolling over, and you have to think of a good reason for it not to happen. So that's why I look at the fastest horse in the race, to me, is leading the way downward. And then it's all the speculation I hear about in the alts. I think it's great. It's wonderful. I come from that environment, but it's one of those things where you look at it at some point when beta goes down, that stuff should lead the way. And this is what I'm looking at right now is Bitcoin is potentially leading the way.
Yeah. And you can make that case because Bitcoin made its last all-time high back in March, right? It hasn't made a new all-time high since March. And the stock market obviously made an all-time high after that. So we have seen, and you're right about this, if you look at a chart on Bitcoin going back to 2021, it topped out, I think, about 2 months or 6 weeks prior to the stock market topping out. And then we know what happened after that. We had the bear market of 2022. So it would be fascinating. And we talked about this before, but you're thinking that if we really see, let's say, a drawdown in the stock market of 20% or so, you could see Bitcoin back in the 30,000, mid 30s, right?
Yeah, so let's put it this way. The high was around 73. 50% corrections are normal in Bitcoin, particularly when we think of how it happened. So it puts it in the 30 handle, and it puts it on a more historical relationship with the S&P 500 and with gold. but this is where the main problem is. Beta is so stretched, and it does go down. It goes down. It has a good reason now. We're heading towards recession. It's also the key things I'm worried about human nature. I've never seen a more widely anticipated rate cutting cycle in my lifetime. I mean, and we're priced completely. Buy the rumor, sell the fact is pretty significant when you see this. Okay, the Fed's going to start cutting rates here. We've already done it. It's just that's what's kicking in, and that's why I'm worried about just normal reversion. And I don't want to sound, trying to scare people. It's just these are great opportunities, but we have to have our outlet. Have to point it out. It's just when you go back that far, that to me is really what's kicking in. It's the bottoming volatility. That was one of the key indicators I had. Is volatility is so low, and I mean I look at it, let's say a 200-day moving average in the VIX just starting to pick up. So.
One of the things that I've been meaning to ask you is so if we follow out what's going on and the Fed's going to start cutting rates, let's say we do have a recession, the government certainly isn't going to stop spending during a recession. In fact, that's when they're supposed to spend more. So you have this debt in the U.S. continuing to go up. The Federal Reserve's balance sheet starts to expand. Money gets cheap again. Where does it all end? Like, it seems like they just have to keep pumping more money into the system to just keep us afloat. Does it end in all out collapse of the system, the financial system? Like where do you think we are in 10 years from now? I mean, are we in major trouble or are we doing fine still? I know it's a hard question. Sorry.
That's the thing. We'll go through the iterations. What you described and what we're seeing right now is a global logical tilt towards recession based on the lessons of massive pumps and liquidity, based on what's happening with the massive expansion of the economy in China. And then, of course, they'll tilt away from the peace dividend we've had for 30 years. To me, that's the whole shift backwards, taking that peace dividend out. Some of those of us who remember when the collapse of the Soviet Union fell, the whole world really changed. So to me, it's one bridge at a time. So what you described is probably what's going to happen. We fully expect priming the classic Keynesian economics. You prime the pump when things crash, and that's part of the problem. We've already been priming the pump, 7% deficit spending, despite the fact of no war, no recession. And I do enjoy when people say, well, that's going to keep bond yields high. Well, yeah, relative, but compared to China, we're very high. Compared to the rest of the world, we're still very high. Typically, U.S. yields are much lower. So that to me is still the opportunity. But I look at it as, I don't really know, but I'll take it one bridge at a time. From a tactical investment standpoint, I think it's a classic indication you're supposed to be underweight risk assets and overweight risk off assets. I still think gold and treasury long bonds will be some of the best performers. Maybe for years, but I don't know how long though.
Do you think there's a chance, so we know that in the 80s, Japan made an all-time high and then didn't make a new high for decades, obviously. Do you think there's a chance that the U.S. has pulled forward so much of the upside that there's a chance we could be in it for a decade of no new all-time highs?
Well, that's what history suggests. I mean, I have to go back to this chart. And when people were calling for, when we had that big money pump back in 20, 21, 22, and prominent economists, even Lynn Alden was saying, oh, it's like the 40s or the 50s or the 70s. I'm like, no, it's the 20s. It's like the 30s. It's the 20s on the way up and potentially 30s on the way down. So that's the U.S. But we have the lessons of history to know what to do, what we did wrong then. It's just looking at the valuations, watching what Warren Buffett is doing. He's way overweight cash, and he's selling equities. It's. I don't know how bad it's going to get, but we do have that the privilege in the U.S. that makes a big difference. And the thing is, U.S. assets are so expensive now versus the rest of the world. So the U.S. stock market versus S&P 500 versus MSCI ex-U.S. index is the highest ever. And I think that's 40 years of data. The U.S. stock market, S&P 500 versus the Bloomberg Commodity Index is the highest in about a quarter century. And you just can keep going down the list that, okay, just a little reversion. But that's the key thing about markets. Mean reversion is a very powerful force.
Yeah. And just for everyone out there, for me, in my personal portfolios and stuff like that, I'm generally short equities, U.S. equities, short the NASDAQ, short the S&P up here. I even have some semiconductors short, but I do have some long positions. One of my long positions is Baidu down here, which is a China stock trading at a forward PE of 8. And it's not to say that this won't go lower, right? It very well could, but at least the valuation, like Mike's saying, is that, you have the equivalent company like Google trading at a 20, 30 PE ratio. This is at an 8 PE ratio, arguably with better growth if China can start to even recover a little bit, but even in these levels. And then the same thing too, I did pick up some call options. I gave myself 2 years on these, but I did pick up some call options on the FXI, which is the large cap China ETF. And still, listen, there's plenty of risk there, so it's a small allocation of the portfolio. But, I'm looking at the same charts in terms of saying, what's overvalued? Is it that Dow Jones Industrial chart we just looked at that was at a trend line that marked tops, major tops? Or is it something that's been beaten down where at least there's some value where if that kind of has a reversion trade, we might see a little bit of upside on those? And granted, I'm a swing trader, so I'm much shorter term as well.
So I love your strategies. And I think that's spot on. Is bear markets offer the best opportunities for sharp short covering rallies. And China equities are so beat up. Now, I do think China is heading towards a Great Depression. But 1933? It was 1936 or so, or some of the best years ever for the U.S. stock market. Yeah, you get all those. Now, these are just more minor trades. But the key thing that's been happening, I read from my colleagues who are based there, is they've been trying to pressure bond yields to go higher, and they've been unsuccessful. There's that much of a flight to quality. And they are starting to buy stocks, their own stock market, like the Japanese have been through ETFs. And that's a bit of a decent floor below the market, but there's a potential trade. And I'm very bearish on China, but at least for a trade, buy a little China like you're doing, sell a little bit of just US for some reversion.
Yeah, very interesting. So again, we have gold. Gold is doing well, even though we've seen silver pull back. We've seen gold hold near this 2,500 level. Do you think that gold would sell off with Bitcoin and the stock market, or you think it's going to still just continue to grind higher?
Yes, but so gold's biggest problem is bull markets do get extended. Managed money net positions in gold are way long, about 44% of total open interest and COMEX is long. The highest it ever gets is like 48. So you hit stops. Let's say if the S&P 500 is down 5% tomorrow, I hope that doesn't happen. Yeah, they're going to hit stops in gold, but that's a short-term blip for gold. That's very bullish. It's deflationary. It'll bring in the bigger long-term, and those ETFs that have been down for 2 years will just start reverting back upwards. So short-term, it definitely is going to hurt. Here's the problem I've had with when people are saying when stock market goes down, Bitcoin's going to go up. It's 3 times the volatility. It's a highly speculative digital asset. We've never seen evidence of that in the short term. So I'm still expecting beta go down and all risk has to go down. Copper, crude oil, and definitely Bitcoin. In the short term, gold will bottom, but then take off and that'll accelerate. So I think it's just a matter of time gold gets to 3,000, but it can't be easy.
Yeah. Now, we'll end it with this. We have the jobs data tomorrow. I think they're expecting 164,000. Are you thinking that's going to be light, just like the ADP number, or could it be a surprise and maybe the market gets a relief rally? I think we both agree markets are going to go lower overall over the next couple months. But do you have any guesses on the jobs number tomorrow?
Yeah, but the estimate on the terminals for 165,000. And 4.2%. And I expect overall the number will probably be spot on. If it's weaker than expected, it'll validate everything the market's already done. If it's stronger, we should get a bounce in the stock market. But that's what I'm worried about. Even I don't think the number is going to matter. If we get a number that's somewhat a little bit stronger than expected, the biggest trade is if the stock market goes down. That's an add to your short position. It means it doesn't matter. It's just up too much, and we just need to take profits as we head towards the election.
Yeah, and I'm with you on that. I think I don't know what the number will be, but if it happens to even come in line with estimates, I think investors breathe a sigh of relief for a day and say, all right, thank goodness we're not falling off a cliff like we saw from the JOLTS data, the ADP numbers, and maybe there's a relief rally for a day, maybe into early next week. And then I think, again, all eyes start turning back to the more macro data coming out from there on out. We'll get CPI soon. We'll get obviously the Federal Reserve later in September, potentially talking 50 basis point cut. So, I mean, they're nervous. If they're willing to cut 50 basis points at the first cut, they are nervous about the economy. And I think that tells us a lot about where things could go as well.
So I'm pulling up the economic surprise index, and I've been looking at this one for quite a while, but it reached, now this is a bunch of them, but virtually every country and it recently reached a 10-year low. So it's not just, it's just one number. It's that whole trend towards economic weakness in all indices. So even if let's see, in a true recession, we should expect inflation data to come lower than expected. That's what happens in recessions. You get deflating lack of demand pull. But this is the thing consistent. Economic surprise index is minus 42, was recently like minus 60. That was the lowest since 2015. So everything's tilting that way. And but the thing is, the Fed's not going to start easing for a while. And now I think we're in that cat and mouse game where markets priced for perfection, and that recession that we didn't get, that everybody was priced for, and then we priced against, is just starting to turn back to what's probably happening and get a real recession.
Amazing. Amazing. All right. Well, it's 3:30. Well, let's call it a day. But this was an amazing discussion, Mike. Thank you so much for jumping on here with Market Mavericks. I hope everyone out there enjoyed it. Please leave comments. If you did enjoy it, we'll come back strong next week. I think Scott will be back, and we'll go right back to it. So thank you guys so much. Thank you, Mike. And follow Mike below. You can see his Twitter handle down there. And we'll see you next week, guys. Take care.